If it's been bullish and we see a consolidation and it runs what side of the marketplace first? The buy side. So it's doing what? Taking those traders out that were short, they're stopped out. It's taking traders in that want to buy on a breakout and then attacking what? Their sell stop. So what is the narrative here? Consolidation with underlying bullish bias. FOMC is the high impact news event for Euro for the week. The market breaks out of the consolidation, takes buy side out, trips traders long, then attacks them. If it does this on FOMC, or if it does something like this at any medium or high impact news event, you have a trade. You can be a buyer down here, or you wait for any type of small little retracement as it starts to move back up. Right in here, small little retracement in here. So anytime you have down candles, think about this right here, institutional order flow. If you're bullish and we had some type of manipulation, a stop run, the market is now allowed to move higher and reprice higher. It won't always give you a run, optimal trade entry, buy more, run, optimal trade entry, buy more. It won't do that. When we're close to a higher time frame target, in this case, you're going to see less pullbacks because it's just going to keep repricing until it gets to the objective. The market structure that's in play, which is what we have been contending with all through here, is all on a larger term consolidation on a higher time frame on the daily chart. So on the hourly, you can really see it's clearly defined as a consolidation. And then you have this. So it shows you that, yes, it's time. What's it time for? It's going to run higher. But what is it doing? It takes the retail traders short out and puts them in long, then raids them. So who's in the marketplace now? No one. Now, I'm not saying, some of you are going to be like, oh, I was in this trade. What are you talking about? What I'm saying is this event here takes into account near-term liquidity. So the open float above these highs here, they attack that for two reasons. Neutralize shorts, engineer new entries on a breakout with buy stops. So traders that want to buy when it breaks above here, because they may have a bullish bias too. And if it goes up here, they think it's going to keep on going. Well, the algorithm has something for them too. It runs up, puts the shorts out, and puts the longs in, then attacks them. Why does it do that? Think about it. Why would it want to do that? Well, I'm trying not to personify the algorithm, but the logic behind it is the shorts is not going to make any money. Okay, shorts aren't going to make any money. So that's just they're just a casualty of war. The buy side liquidity, they want to set what in motion? They want to put traders in long. Why? Because that's going to engineer new sellers below the market at this time. So where are they going to look for that? Below here. So what's going to be below here? Once this move happened, sell side liquidity is going to immediately enter the marketplace where it wasn't there before. Because it ran out, it took the buy side liquidity out here. Now, once it does that, the algorithm is designed to go back down here because of the mindset of traders. They're going to be buying all this. They're going to chase it. And when you buy something, how do you protect that position? You put a sell stop in. Okay, so where's the sell stop going to go? Right below here. Okay, great. When the market trades down there, what does that facilitate for the smart money trader? They can buy those sell stops. So those sellers are being paired up with more informed traders. So they're buying at the low of the day during FOMC, scooping up that and rallying up. And notice how every time we have down close candles, like all this is 1, 2, 3 down close candles consecutively. So what happens is the market trades above it here and then works back down into it. That's working in an order block. So this is a buying opportunity. Rallies up. Here's a down close candle right there. It's small, but what would you expect after the down close candle? Range expansion on the upside. Down close candles, range expansion. Down close candle, range expansion. Down close candle, range expansion. Down close candle, up candle. Down close candle, up candle. And now we're at the objective of the order block. That's institutional order flow. In instances where you're bullish, okay, anytime you see a down close candle, that's an opportunity to get ready because we're going to see another range expansion on the upside. That's institutional order flow. Now, that's not everything about institutional order flow, but it's how you watch the tape. You don't look at down moves and grow disenchanted or impatient thinking I'm wrong or second guess yourself. You anticipate the next drive higher in the candles that form after these close on the downside, like these little down black candles. The next candles in my chart should be green. And every time you start seeing that, okay, it's confirming that you're on side. That means you're on the right side of the marketplace. Do not be fearful of down close candles or consolidation. That's the normal ebb and flow of the marketplace. Moving into the 15-minute time frame, you can see again, nice clean levels, punches down on FOMC, rallies back up, trades back down into the order block relative to the hourly chart. You see that here. Rallies up again, trades back down into what? This down close candle, which is a bullish order block there. Rallies up, down close candles, green. Down close candles, green. A little bit of consolidation in here. And another leg up each time. But every single time you see down close candles, you want every candle to be going in your direction as a new trader. And you don't like the uncomfortable feeling of when it's pausing or having a little bit of retracement. You lose your mind over that. The only way you're going to learn how to trust daily bias and know when it's favorable is by understanding the economic calendar, market structure, and understanding institutional order flow. The institutional order flow is the last thing in this list, but this right here is assuming that you know what this is, the draw on liquidity. And that's assuming you know how to find the high when you're bullish and knowing that you're going to be buying at or just below the opening price or near it in New York. So as a reminder, just letting you know, daily bias is possible, but daily bias is not everyday bias. Not in the sense that it's going to pan out every single day the same way you want it to. But if you are looking at a higher time frame chart and you're trying to predict the more upside or the more downside on the weekly range that's about to form, if you spend time with trying to do that and sometimes even submitting to Monday's trading and let Monday tell you what it's likely to do, go in here and start looking for 15-minute chart highs and lows and hourly highs and lows, and you'll see what it's going to most likely run to. And does that fit your expectation for the weekly range? Is it likely to expand up? And then when Monday's trading happens, does it still leave equal highs? Well, it might be running those on Tuesday and Wednesday. So what would that be suggesting to you? That your idea about that weekly range expanding on the upside and your bias for being a bullish trader, that might be something you could be probing on Tuesday and Wednesday of that particular week, especially if there's a high impact or medium impact news driver during the London session and or the New York session. So you're blending time and price, and you're also incorporating the narrative idea. You have to have an idea why these markets should be going where they're going. It's not an everyday bias. If you take a long and you were expecting a big range on the upside, and it creates a down day and stops you out, should you abandon that bias? No, because as I mentioned earlier in the video, if you have a down day when it's underlyingly bullish, many times right after that down candle in a daily chart, you have a really big upside day or a series of up days. That's why it's important to be focusing on these higher time frame charts and getting a feel for what they're reaching for. And the key is understanding that calendar and market structure. And if you understand those and you can see what you're looking for the next draw on liquidity, you can see that there's several ingredients that's necessary for that recipe to deliver bias, at least a meaningful and quote unquote profitable bias. You only need one day of the week where you think your bias is right. How do you do that? I've already taught you the economic calendar. You wait for market structure to get in alignment with that manipulation, and then you have the setup. That's your trade. That's your setup. Anything else around that would be scalps for the week. But your bread and butter setup for that week is always going to be coupled with market structure and the economic calendar for that particular market that has the news event around it. That's daily bias. It's that day's bias. You see how I did that? It's not every single day it's going to be an up day. No, it could, but I'm only focusing in on the days that are cherry. And that's why it looks like I'm cherry picking my trades.